Good morning, good afternoon, or good evening. Depends on the time you're viewing our webinar. Thank you for joining us today for the Cornerstone 2026 Market Update. I'm Jeff Carbone, founding member and managing partner at Cornerstone Wealth, joined by our Chief Investment Officer and my partner, Cliff Hodge. Well, we have a special year ahead as the Cornerstone Wealth team celebrates our 25th anniversary of serving you, our clients, and we thank you for all the recommendations and introductions over those years. It's our honor and pleasure in helping you all. Okay, for the individuals and families we served in 2025, it was not about chasing returns. It was about managing risk in an environment where policy, rates, and valuations all mattered, more than just the headlines. As times change in the market and the economy, portfolios face a different challenge. Taxes matter, volatility matters, and protecting capital during periods of uncertainty is just as important as participating in upside. 2025 was another strong year for equity markets, and as we closed, it was the third year in a row the S&P 500 was up double digits. This is not the norm. In fact, in market history, there have only been 3 other times where markets were up 4 years in a row. Can 2026 make it 4? The fixed income markets also provided us solid performance as rate cuts from the Fed Reserve came to fruition. Today, Cliff will look back and review what actually drove the results in 2025 across the equity markets, fixed income, and alternative strategies. We will then focus on what's ahead for 2026, the macro view, where key risk may lie, positioning of portfolios, where opportunities are emerging, and how the 3 Ps of process, planning, and patience, matched with thoughtful portfolio construction from your advisor, can help our clients continue to navigate what's shaping up to be another transitional year ahead. Cliff, let's start by putting 2025 into context, starting with where we were rewarded, and just as importantly, where investors were not.
Thanks, Jeff. If 2025 taught us anything, it's that the markets are incredibly resilient. We faced a change in a presidential administration, the highest tariffs since the Great Depression, and even a government shutdown. Despite these headlines, the market did what it often does. It climbed a wall of worry, and investors who stayed the course were rewarded with new all-time highs throughout the year. This serves as a powerful reminder that while the news cycle can be loud and volatile, long-term returns are driven by fundamentals and not narratives. To put some context behind that resilience, 2025 was a year of strength in numbers. The S&P delivered an 18% return, nearly twice the long-run average, and it wasn't just the mega-cap tech giants doing the heavy lifting. Nearly 2/3 of the companies finished in positive territory. This breadth is a healthy sign, as the rally was supported by a wide range of sectors and companies. We also finished the year out on an 8-month winning streak. That's the kind of momentum that can carry us forward into 2026. When we review the economic data, the economy remains strong. Growth surprised to the upside, inflation continued to cool, and while the labor market stagnated, the Fed stepped in to support the economy and markets, cutting rates 3 times in 2025. More encouraging, earnings did a lot of the heavy lifting and powered the market higher. When we look globally, the story gets a lot more interesting. While the US had a great year, international and emerging markets stole the show, with returns topping 30%. Bond returns were steady as well, at around 7 to 8% as rates stabilized during this year. That speaks volumes for the need for diversification. Another way to look at breadth is through the lens of sector and factor returns. These are the underlying components of the broader market. Every sector and factor that we track had a positive year. This is quite remarkable, and we believe that this broadening out theme could continue into 2026. So that's the story of what happened in 2025. So now let's shift our focus from what happened to what matters most in 2026: growth, inflation, and policy. Macro isn't about perfect prediction. It's about identifying the major headwinds and tailwinds, and then take this information to position our portfolios for a higher probability of a successful outcome. So we'll start with consensus expectations, where the view is that the global economy will remain solid. And in fact, the US and Australia are the only two major economies where growth rates are forecast to accelerate. On the other hand, inflation is expected to stabilize and continue cooling. That combination, rising growth, stable or falling inflation, is generally supportive for both stocks and bonds, especially when central bank policy is accommodative. And on the topic of central bank policy, we see here that the United States is an outlier. We are expected to be the only major economy actively easing while the rest of the world steps aside, or in the case of Japan, who may actually raise interest rates. This setup usually leads to a weaker US dollar, which paradoxically can be very good for risky assets, especially in markets outside of the US and tangible assets like precious metals, real estate, and commodities. The Fed is also no longer shrinking the balance sheet, providing additional liquidity to financial markets in the economy. And recently, the Trump administration directed Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage-backed securities in a direct bid to bring down housing costs, which is all very bullish for markets this year. There's also a significant fiscal boost hitting the economy this year through the One Big Beautiful Bill Act, which will have a direct impact on the American wallet. The average American is looking at a tax refund of over $3,200 this year, a 43% increase from last year, which will directly support consumer spending, especially in the first half of the year. And as we know, consumer spending makes up 70% of the economy, so we think this is quite significant. One area not firing on all cylinders is the labor market, which remains somewhat stagnant as hirings and firings remain low. The good news is that historically, corporate profits are a key leading indicator for the labor market. If profits hold up, companies tend to protect payrolls, which support spending. And we're watching profits and margins very closely as an early warning signal. Some of the other leading indicators we track on the labor market appear to be turning positive, which for now gives us confidence that the labor market can remain solid and that job growth could pick up. To summarize, our base case is that growth improves, inflation remains benign, and the Fed eases, which is a very constructive macro mix. That doesn't mean volatility is going to completely be eliminated, however. So again, we are going to reiterate the importance of asset allocation and diversification. So now let's turn our attention to the fundamentals of the market. After understanding the macro as a backdrop, the key question now is what's priced in? Markets can do fine in a good economy unless expectations outpace reality. So now we'll turn our attention to focus on the fundamentals: expectations, valuations, and earnings. So what does Wall Street think? Interestingly enough, everyone appears to be looking in the same direction, and surprise, it's bullish. We're seeing a bit of a clustering and some herd mentality, with analysts predicting roughly a 10% gain for the S&P 500 this year, right at the long-run historical average. And while it's nice to see consensus optimism, and 10% seems like a reasonable base case, as your advisors, it's our job to manage your portfolio so that we're not relying on everything going perfectly according to plan. That means asset allocation aligned with your long-term goals and diversification to provide competitive returns while reducing the overall volatility and market risk. As we can see, history shows that the market almost never has an average year. In fact, there have only been 4 instances since 1950 where returns have been between 8 and 10%, the quote-unquote average return. The macro matters, as we've discussed. A good economy and a supportive Fed are tailwinds, but the starting point also matters, as higher valuations typically mean lower forward expected returns. And there's no getting around it. Stocks aren't cheap. By historical standards, we're quite expensive, in the 96th percentile, over the last 20 years. This doesn't mean that a crash is imminent or that you should rush out and sell all your stocks. But it does mean for that stock prices to keep going higher, companies are going to actually have to deliver the profits that they promised. This means that fundamentals, not multiple expansion, must do the heavy lifting in driving returns. There are some areas that do look more attractive. value stocks, which have exposure to more cyclical sectors, small caps, and international markets are areas where we're leaning in. As we mentioned, the bull case relies heavily on earnings growth continuing. And right now, the street has a forecast of 15% growth rate in earnings this year, which is a pretty lofty target. Fortunately, when we focus on the 493, which strips out the Mag 7 mega cap technology stocks, it actually looks doable, especially if the economy reaccelerates. This earning picture reinforces our view on this broadening out theme that we've discussed. It's not to say we want to abandon our AI exposure, far from it. But we do want to make sure that our portfolios also have exposure to less expensive and more pro-cyclical sectors. So what does history say? 2026 is a midterm year, which historically averaged about 8.8% during a president's second term. Again, right near that average return level. Midterm years are often the most volatile years during the four-year cycle, however. The good news is that the pre-election year, year 3, is historically the strongest under second-term presidents. So if history rhymes, both 26 and 27 could be solid before volatility takes hold in an election year. And just a quick word on fixed income. Not much new here. Same general theme that we've discussed over the past few years. High yields and tight credit spreads. It's good that bonds can provide meaningful income for us this year, though investors aren't getting paid to take on significant credit risk. We actually want our bonds to be boring. We want interest income, and we want them to act as a buffer against equity volatility. We do continue to be overweight mortgage-backed bonds. They're very high quality, and we've discussed the tailwinds from Fannie and Freddie buying these bonds this year. So in summary, we've got high starting valuations, and earnings have to be the key driver of returns. We do expect some volatility, but also a broadening from mega cap technology stocks. Finally, we'll end our review of markets with our dashboard, which is a visualization of our repeatable risk management process framework and our 3 key pillars of analysis: macroeconomics, fundamentals, and behavior. Putting it all together, our view is that markets are setting the stage for a year of solid, but likely not spectacular returns. Diversification, not just in equities, but also in fixed income, alternatives, and private markets, is going to be paramount for 2026 in all our investor portfolios. So what are we doing with all of these views? In a nutshell, we're leaning into opportunities while respecting elevated valuations. This is where portfolio construction matters and where the rubber meets the road. 2026, as we said, is going to be a year of diversification. Across growth assets, we're leaning into value, international equities, and small caps, and favor private equity and venture and private market portfolios for qualified investors who can tolerate some illiquidity. We don't want to reach for yield in public fixed income, and we think that high-quality private credit and real asset income funds can enhance yields and reduce public market volatility. We also think now is the time for investors to take a harder look at private real estate. We've already experienced the real estate recession. Prices are down 20% or more in commercial real estate, while rent growth has remained positive at the national level. This is a rates problem, not a market fundamentals problem. And now the Fed is cutting. Housing affordability remains a key issue, where renting is just much more cost-effective than buying a home. On the public side, public market REITs have already rebounded from the bottom, and we think private real estate could be next. We're actually quite bullish on the asset class over the next 3-year cycle. What could go wrong? Well, any number of things, but these are top of mind. Rising interest rates are the biggest swing factor for investors this year. If all this stimulus overheats the economy or stokes inflation, we think that's our biggest macro concern. Though it likely wouldn't come through the data until later into the year or even into 2027, but it's something we're going to be watching quite closely. Other things that have our attention: labor markets, the AI hype cycle, and Magnificent Seven concentration risk, especially as we go through earnings and we're looking at CapEx. There are some other wild cards, including the indictment of Federal Chair Jerome Powell over construction costs around renovations and geopolitics, which, as we know, are quite unpredictable. We can't predict geopolitics, but we can prepare for volatility. Second-order effects matter here tremendously. Markets can and often do react differently than what the headline suggests. So we're going to focus on what we can control. That's asset allocation and diversification. So to summarize, the green light is on with the macroeconomy, with growth accelerating, inflation cooling, and the Fed supporting markets. This backdrop is very positive. However, stocks are expensive. We believe that broadening out your portfolio into value, small caps, and international stocks is a great way to find a better deal and to stay invested. Finally, we're leaning into private markets and real estate. Our goal here is to ensure that your legacy is built on a foundation of diversified, high-quality assets that can grow regardless of what the headlines say next. Thank you for joining us today and for taking the time to be here. We know you have a lot of choices, and we don't take for granted the trust that you place in Cornerstone. Our commitment is to stay disciplined, to stay proactive, and to keep your plan aligned with your long-term goals, especially when the headlines get noisy. If you have questions or want to talk through how today's outlook applies to your portfolio specifically, we're here for you. Thank you again so much for your continued confidence and partnership. Back to you, Jeff.
As we wrap up today, a key takeaway that remains: successful investing is not about reacting, it's about planning. Cliff shared a slide early in the presentation showing all that transpired in 2025. It was a pretty busy year. We even named the first pope from the United States. 2025 reinforced that markets will continue to evolve, policies will shift, and uncertainty will always exist. At Cornerstone Wealth, our message remains consistent and built upon purpose while aligning with our clients' long-term objectives. Long-term success is not driven by short-term forecasts, but by discipline, diversification, and decisions grounded in evidence rather than emotion. As we look ahead to 2026, our focus remains on prudent portfolio construction, tax-aware strategies, and ongoing planning, recognizing that wealth management is not about a single year's outcome, but about consistency across full market cycles. Thank you for your time and your continued trust in Cornerstone. If tonight's discussion prompts questions on how these themes apply to you, your personal situation, we welcome the opportunity to continue the conversation. Reach out to your advisor or to our office. We will share the webinar on our website at www.cwgadvisors.com, as well as sending an email. Feel free to share it with family, friends, and colleagues. As I mentioned, 2026 is a very special year for the Cornerstone team, as we look forward to celebrating our 25th anniversary of serving you, our clients, and our community. We thank you for allowing us to be part of your team and your financial family. We look ahead to the next 25, 30, 50 years and beyond. We'll always strive to provide clarity and confidence to you, our clients and friends, as a cornerstone of your financial lives. Wishing everyone good health and wealth in the year ahead.